Welcome to Finance for World. Okay, let's dive into this. Right now, we're looking at a massive convergence of global crises that is literally testing the limits of our markets, our central banks, and everyday consumers. We are in the middle of a true perfect storm here in 2026. We've got a massive tech bubble deflating, an unprecedented geopolitical conflict breaking out, and a really stubborn resurgence of sticky inflation all colliding at the exact same time. To really grasp the sheer scale of the wild volatility we're dealing with, just look at this number, $400 million. That's the value of highly leveraged crypto bets that just evaporated in a single day recently. Gone. When borrowed money gets wiped out this fast, well, it's a huge red flag. It serves as a visceral hook, a stark warning sign of the wild swings and intense market vulnerability currently sweeping across the globe. But to understand how we actually got to such an incredibly fragile point, we have to unpack the first major pillar of this storm. Section 1. The AI tech bubble, the spark that ignited market vulnerability. And this brilliantly illustrates exactly how Wall Street got totally blindsided here. You see, tech megacaps were fully expected to pour a mind-blowing $1.6 trillion into AI between 2026 and 2029. But then came what we called the DeepSeek catalyst. In early 2025, this relatively cheap yet highly capable AI emerged out of nowhere, proving that advanced models didn't necessarily require endless trillions in spending. That single revelation triggered a massive reality check, wiping out approximately $600 billion from Nvidia's market cap in just one day. Suddenly, the entire foundation of the tech boom looked, well, incredibly fragile. And this wasn't just a momentary glitch either. As critics have pointed out, this market reaction exposed a much deeper, broader anxiety, specifically a growing public disinterest within the AI market, combined with the deep vulnerabilities of companies actually producing and marketing their own AI projects. Basically, tech momentum completely stalled out. It killed the market's absolute strongest growth engine at the worst possible moment, right before a massive global shock hit us.
Section 2. The 2026 Iran War. Geopolitical shocks and global chaos.
Just as the tech sector started deflating, the world got hit by our second pillar. Let's trace the facts impartially to see how this escalated so fast. On February 28th, joint U.S. and Israeli strikes targeted Iranian leadership and military infrastructure. Things escalated dramatically by early March, as Iran retaliated and the critical Strait of Hormuz was blockaded. Then in late March, Houthi forces officially entered the conflict, heavily disrupting the Bab el-Mandeb Strait. This timeline shows how, in just a matter of weeks, the fundamental arteries of global trade were completely severed.
These military actions instantly paralyzed global logistics. Overnight we saw Asian airspace completely close, grounding thousands of commercial flights. Commercial shipping vessels were forced to totally abandon the Suez Canal. They're now rerouting thousands of extra miles all the way around the Cape of Good Hope, which adds weeks of travel time and massive costs to everyday goods. And with simultaneous conflicts erupting, even Central Asian land trade routes were heavily disrupted. The world map of trade literally had to be redrawn in the blink of an eye.
Section 3. The global supply shock, beyond just oil. Now, what's really interesting about this slide is that this blockade didn't just stop oil. It created a multifaceted supply shock, hitting everything from agriculture to advanced manufacturing. Sure, energy spiked, but look at tungsten, an absolutely critical industrial metal. Its price surged an unbelievable 557%. And it's hitting basic human needs too. We're seeing massive food inflation right now, with cereals up 140% and dairy up almost 117% inside Iran, sending massive ripple effects all around the globe.
But it gets even crazier, because this is quietly threatening the very core of modern technology. We are seeing sudden shortages emerging in incredibly rare essential commodities. Sulfur flows, which are absolutely crucial for global mining and industry, are choked off. Helium, which is critical for manufacturing semiconductors, is suddenly at risk. And on top of that, a global fertilizer shortage is directly threatening global food security. It's a brutal irony, right? The AI tech sector was already bleeding. Now it turns out they might not even be able to get the raw materials they need to build their chips.
Section 4. What it means for you. The real-world impact. So how do all these abstract macroeconomic and geopolitical shocks actually translate to daily life? Let's ground this with some vivid examples. In the Philippines, they actually had to declare a 4-day work week, which sounds great until you realize it's just because they have to heavily ration electricity during an energy emergency. Over in Vietnam and Pakistan, citizens are facing severe fuel shortages and widespread panic buying, and in India,
Over 220,000 highly skilled professionals, known as returnees, are fleeing the Gulf. They are literally abandoning their jobs as the region's safe haven status is completely shattered by the conflict.
And here in the United States, the compounding weight of surging gas prices and a skyrocketing cost of living has driven consumer sentiment to a completely record low. Make no mistake, people across the board are feeling the intense, painful reality of this economic storm. Section 5. The Federal Reserve Dilemma. Trapped between growth and inflation. Let's move to and see how this builds as central banks face this impossible situation.
Talk about a tough first day on the job. Enter Kevin Warsh. He is the newly sworn-in chairman of the U.S. Federal Reserve, taking the helm right in the middle of this unprecedented crisis. Sworn in at the White House by President Trump, Warsh is stepping into the role at the exact moment markets are reeling from historic volatility and the massive geopolitical shock of the war.
The immense pressure from all this is already shifting the Fed's trajectory. Just listen to this quote from Fed Governor Christopher Waller. "I can no longer rule out rate hikes further down the road if inflation does not abate soon." Think about that. Just a few months ago, the market was banking on relief and rate cuts. Now, because this inflation is sticky, meaning prices shoot up and stubbornly refuse to come back down, the Fed is having to seriously consider hiking rates again, completely upending Wall Street's expectations.
The new Fed chair faces an absolute avalanche of compounding pressures on his balance sheet. He has to navigate a surging U.S. debt load, the highly unpredictable labor impacts of AI, a massive $200 billion war supplemental budget, and of course, that incredibly sticky inflation driven by the oil crisis. It is a monetary balancing act with literally zero margin for error.
Section 6. The Triple Test. Looking ahead. So, the crucial point is that we are not dealing with isolated, distinct events here. We are witnessing three massive forces colliding all at once to seriously test the global economy. Step 1. The tech bubble deflation, which eroded the foundational growth engine of the stock market. Step 2. The geopolitical energy shock, which paralyzed global supply chains and spiked commodity prices. And Step 3. Resurgent inflation, raising the terrifying ghost of potential central bank rate hikes right when the economy is at its absolute most fragile.
Which leaves us with one final, urgent question. How long can the global economy actually sustain these compounding pressures? We are in completely uncharted territory right now, and the resilience of our global markets is being tested like never before. Thank you so much for joining me for this explainer today. Keep a close eye on the data, stay curious, and I'll see you next time.